Hello and welcome to OA Accountancy Staff. In today's video, we are beginning a new topic called the double entry rule or the golden principle in accounting. This is the rule that guides how entries are recorded in the various accounts. So this is the rule that guides how entries are recorded in the various ledgers. This rule was propounded by an Italian mathematician known as Luca Pacioli in the year 1494. This golden principle or the double entry rule was propounded by an Italian mathematician known as Fra Luca Pacioli in the year 1494. And as we said, this is the rule that still guides the recording of accounting transactions in the various ledgers till date. Fra Luca Pacioli, in short, is known as the father of accounting due to his ability to propound this rule. So before this rule, organizations and entities were only taking into consideration one effect of a transaction without taking into consideration the other effect. So this rule specifically states that every accounting transactions should be recorded twice, that's in two books. One should be in the receiving book and the other should be in the giving out book. So it states that you should debit the receiving book and then credit the giving out book. It goes on to say that every debit entry should have a corresponding credit entry, and as well as every credit entry should also have a corresponding debit entry. So what it means is that a transaction like, let's say, cash purchases, you cannot debit purchases and the same time you cannot debit cash account, and at the same time debit purchases account. It needs to have every debit entry should have a corresponding credit entry. So this part the rule specifically states. So as we said, every transaction needs to be recorded in two accounts or books. So before we proceed, it will be very beneficial if you get to know a little about an account and what it entails. So as said in our previous videos, an account is a page of a ledger that contains the historical records of the items and person or people the organization deals with. So we are saying account is a page of a ledger that contains a page of a ledger that contains the historical records of the items and or people an organization deals with. When we say a page of a ledger, it means that the ledger itself is a full book and an account is a page of a ledger. So this full book could be considered as a ledger. So assuming we name this book as the sales ledger, every single page of this book is an account. So this is a typical specimen of how an account looks like. So in every account, as we said, it is divided into two halves. So this side and then the other side. This side is called the debit side, and here is called the credit side. Every account has a title or name of the account. So the name or the title of the account will be written here. Title or name of the account. In every account, there is a place for a date. Mostly, in every side of the account, the date comes first. So this is where we will write the date of the transaction. After the date, there is another place where we write the narration. And the narration is the account where the corresponding entry will be made. We said that in every transaction, it needs to be recorded twice. So this is where the corresponding, or the name of the account where the corresponding entry will be recorded. So after the narration, we have another column that records or takes the ledger folio. And the ledger folio also is the page number of the ledger into which the account appears. And the last one is the amount or the value of the transaction. This amount of the value always takes the currency we are working in. So let's assume we are dealing in dollar. The same applies to the credit. So under the credit too, we have edit, we have narration, we have ledger folio, and then amount. So this is how an account looks like. So it means recording the transaction at the debit side of the account is called debiting the account, and recording the transaction at the credit side of the account is called crediting the account. So after knowing what an account is, let's proceed by looking at the classification of an account. Basically, an account is classified into two. That's the personal and impersonal accounts. The personal accounts are the accounts, or the personal accounts, they contains transactions relating to person and business organization. What we mean by this is that an organization may decide to deal with another person who may be a debtor or a supplier, or another business organization who may be a debtor or a supplier. So in any case, this debtor or supplier, whether it be a person or a business organization, records or historical records are kept in the personal accounts. Classifications of accounts. So we said at first we have the personal, and two, we have the impersonal accounts. So per our definition, we said that account contains records or historical records of the items and person organization deals with. And we said that the personal account, they contain the records of the people the organization deals with. So obviously, the impersonal accounts are also the accounts that contain the items the organization deals with. So these items organizations deals with could be either tangible or intangible. So the items, this contains persons, and these items or property, items. So under the items, it can be both tangible items or intangible. It can be tangible items or intangible items. So the impersonal accounts are further classified into two. One to take care of the tangible items and the other to take care of intangible items or property. So the accounts that's responsible for recording or keeping transactions or keeping records of the tangible items is known as the real accounts. And that for the intangible is known as the nominal accounts. So the impersonal accounts are further classified into the personal and then into the real and nominal accounts. So on this note, the intangible accounts would be replaced by the real and then the nominal accounts. So under the classification of accounts or types of accounts, we have the personal, real, and then nominal accounts. The personal accounts keep records of persons the organizations deals with. The real accounts keep records of the tangible items or properties the organizations deals with. And then the nominal accounts also keep records of the intangible items or properties the organization deals with. So we have the tangible, and this intangible items, the intangible items the organization deals with. So this double entry principle, as stated earlier, is then broken down to cater for each of these accounts. So what it means is that you have a rule for recording in the personal accounts, the rule for recording in the real account, and that for recording in the nominal accounts. So let's get to know that. So as we said earlier, we have a rule for recording in the personal accounts, a rule for recording in the real account, and that for recording in the nominal account. But the general rule is that every debit entry should have a corresponding credit entry, and that every transaction should be recorded in two books. Okay, so under the personal account, as we said, they keep records of the persons the organization deals with. So under the personal account, the rule says that we should debit the receiver and then credit the giver. So when a person or a business organization receives an item, whether it be in cash, stock, non-current asset, or whatever, the rule says that we should debit the receiver and then credit the giver. Okay, under the real account too, the rule says that since this real account does not deal with persons or business organizations, there is no receiver nor a giver. So the rule under the real account states that you should debit what comes in and then credit what goes out. Remember that under the real account, they contain accounts relating to tangible items or property. So when an item or when a property or when something is coming into the property's account, you should debit the property account. When something is going out from a property or an item account, you should credit the item or the property account. So under the real account, we said debit what comes in and credit what goes out. Under the nominal accounts too, we said that the nominal accounts, they contains or they keep records of the intangible items, and the example of intangible items are expenses, revenue, losses, and gains. Bear with me that there is no such expenses that's tangible or that can be seen and touched, nor there is any revenue that can be seen or touched. Though there are expenses, we pay for expenses, but then what we see is the cash that's used to pay for the expenses, but we don't see the expenses themselves. The same applies for the revenue. You can receive an interest of an investment you've made, but what you received is the cash, not the interest itself. So the interest is considered as an intangible, and as we said earlier, the intangible items are classified under the nominal accounts. So under the nominal accounts, the rule says that we should debit all expenses and losses and then credit all revenue and gains. Debit all expenses and losses and credit all revenues and gains. This is how the double entry principle is further broken down to suit each of the accounts. So as stated, under the personal account, it says that you should debit the receiver and then credit the giver. Under the real account, it says you should debit what comes in and credit what goes out. Under the nominal account, you should debit all expenses and losses and then credit all revenues and gains. One may say that, why is it that under the personal account, we debited the receiver, which seems like a positive. Under the row account, we debited what comes in or what came in, which seems like a positive. But under the nominal account, it is revenue rather that comes in. So why are we not debiting revenue, but rather crediting revenue? And an example is, let's say you received an interest on the loan that you gave out to someone. You received, let's say, $100 cash for the loan that you gave out to someone. So let's say loan interest received $100. These are transactions. Loan interest received $100. So obviously the two accounts that should be involved is the loan interest received and then the source of payment, which is the cash account. In this case, the loan interest received is an income or is a revenue account, which is under the nominal account, and that of the cash is also a real account. So it is advisable that in every situation where a transaction involves or the account involves a real account and then a nominal or any other account, you first look at the perspective of the real account. So in this case, we have our cash account and then the loan interest. So in our case, these are the two accounts that's involved. We received $100 from the loan that we gave out. So it means that the $100 is coming in to increase our cash balance or the amount of cash that we are having. So our amount of cash before this loan interest will then be increased by the $100 after we received it. Under the real account, it says that we should debit what comes in, and in our situation, it is cash rather that's coming in. So we will debit cash in the name of loan interest for 100. This is our currency sign. This is our currency sign. So we have debited what came in, which is the cash. So after we debiting the cash account, the double entry principle says that every debit entry should have a corresponding credit entry. There cannot be a double debit. That's you debit a cash account and then you debit a loan account. It is impossible. So the moment you know or you get to know from one perspective, then obviously the other account should be the inverse of what you've recorded in the first account. So in our case, we've debited a cash account in the name of loan interest. So the loan interest account will obviously be credited. So we credit it in the name of cash, $100. So this is why the revenue account should be credited, because at the end of the day, the loan interest received, which is a revenue, has been credited. Thank you. This will be the end of the part 1 of the double entry principle. Under the part 2, you will take a practice question and then solve it with these rules. That's the rule under the personal, the rule under the real, and then that of the nominal account. So, thank you for joining our lesson. Kindly share and subscribe for the benefit of others. Goodbye.